In this video, we will discuss the 5 Warren Buffett stocks that we believe are the safest for investors to buy right now. The current CEO of Berkshire Hathaway, Warren Buffett, is widely regarded as one of the most successful investors of all time. The Oracle of Omaha's company has outperformed the broad-based S&P 500 by so much that its share price could fall 99% tomorrow and it would still be handily outpacing the S&P 500 since 1965. Although there is a long list of reasons for Buffett's success, such as his love of cyclical businesses and companies that pay dividends, one factor that can't be overlooked as a foundational element to his company's superior long-term returns is the fact that Berkshire Hathaway's portfolio is full of relatively safe companies. The more than 4 dozen securities that are currently held in Berkshire Hathaway's portfolio include 5 stocks that are exceptionally safe and are held by Warren Buffett. Patient investors can buy these 5 stocks right now with full confidence. Number 1. Johnson & Johnson, J&J. Investors can start their portfolios off on the right foot by purchasing Johnson & Johnson right now. This healthcare conglomerate is the first stock that Warren Buffett has recommended that is extremely secure. Although it's not a large holding in Berkshire Hathaway's portfolio, it's proven to be a steady moneymaker over the long run. Perhaps the best aspect of healthcare stocks is that they're defensive. People will always have a requirement for prescription drugs, medical devices, and healthcare services, regardless of how the economy and stock market in the United States perform, whether they do well or poorly, or how high inflation soars. People don't stop getting sick just because Wall Street hits a bump in the road. This places a minimum level of demand beneath most healthcare stocks. One of the factors that make Johnson & Johnson such a special company is its operating continuity. J&J has been in business for 136 years, and in that time has only had 10 CEOs. Having continuity in key leadership positions has ensured that strategic visions have been met. Additionally, Johnson & Johnson's business divisions contribute significantly to the company's overall success. While selling brand-name pharmaceuticals accounts for most of J&J's growth and operating margins, brand-name drugs only have a finite period of sales exclusivity. To counter these patent cliffs, the company can, as an example, lean on its leading medical device segment that's perfectly positioned to take advantage of an aging global population. When one door closes with J&J, one or more tends to open. Last but not least, Johnson & Johnson's financial health rivals that of any other publicly traded company on the face of the planet. It's increased its base annual dividend in each of the past 60 years, and is one of only 2 publicly traded companies to receive the highest credit rating, AAA, from Standard & Poor's, a subsidiary of S&P Global. Number 2. And number 3 on our list. Visa, VO, and MasterCard, MA. The payment processors Visa and MasterCard are the second and third extremely safe Warren Buffett stocks that investors can buy with complete confidence right now. We've chosen to discuss both companies together since their operating models, and therefore catalysts, are virtually identical. Like most financial stocks, Visa and MasterCard are cyclical businesses. With U.S. gross domestic product declining in back-to-back quarters, you might be wondering why buying into payment processors would be a wise move. The straightforward answer is time. Even though economic downturns like recessions and contractions are unavoidable, their duration is typically quite brief. Economic expansions, on the other hand, are typically measured in years. Disproportionately long periods of expansion are what allow Visa and MasterCard to thrive. These payment processing kingpins are also number 1 and 2 in the US, the largest market for consumption in the world. As of 2020, Visa and MasterCard respectively controlled 54% and 23% of US credit card network purchase volume. However, because the majority of global transactions are still conducted in cash, the opportunity to sustain double-digit growth through acquisitive or organic expansion exists. As one final note, Visa and MasterCard have shunned lending and strictly stuck to payment processing. In doing so, both companies are avoiding the loan delinquencies and losses that would typically accompany recessions. Number 4. US Bancorp, USB. A fourth Warren Buffett stock that's extraordinarily safe and can be gobbled up by long-term investors right now is US Bancorp, the parent company of the more familiar US Bank. Like Visa and MasterCard, bank stocks are cyclical. This means the recent economic downturn and rapidly rising inflation have generally increased loan delinquencies and encouraged banks to set aside more capital for loan losses. However, because economic expansions last considerably longer than contractions, banks like US Bancorp benefit from the long-term growth in loans and deposits are the bread and butter of banking, as I like to call it. Speaking of the bread and butter of banking, regional banking giant US Bancorp has regularly stood out for its superior return on assets, relative to other big banks. Whereas most money center banks were lured by riskier derivative investments prior to the financial crisis more than a decade ago, US Bancorp's relatively conservative management team avoided these pitfalls. US Bancorp also deserves credit for its top-tier digital engagement push. As of the end of May 2022, 82% of the company's active customers were banking digitally. More importantly, 64% of loan sales were completed online or via mobile app. For some context, only 45% of loan sales were completed digitally at the beginning of 2020. Because digital transactions are substantially cheaper for banks than in-person or phone-based interactions, this digital push is allowing US Bancorp to consolidate some of its branches and lower its non-interest expenses. Number 5. Chevron, CVX. Oil and gas giant Chevron is the fifth and final particularly safe Warren Buffett stock that investors can buy with confidence at this time, CVX. Understandably, the idea of buying an oil stock simply won't be palatable to some investors. It was just a little over 2 years ago that the initial lockdowns tied to the pandemic sent crude oil and natural gas demand off a cliff, which ultimately pummeled drilling and exploration companies. Chevron, on the other hand, is a special breed of oil company that managed to get through a challenging period in the oil and gas sector. The integrated business model used by Chevron is likely the company's most valuable asset. Even though the company's upstream drilling operations produce the highest margins for it, it also owns chemical plants, refineries, and transmission pipelines. Its upstream drilling operations generate the most revenue. Midstream assets, such as pipelines and storage, almost always operate with fixed fee or volume-based contracts. In other words, operating cash flow tends to be highly predictable and transparent. In the meantime, Chevron's downstream refineries and chemical operations traditionally serve as a hedge against falling energy prices. In addition, Chevron is in a significantly better financial position than the majority of the world's other major oil and gas companies. Chevron's debt-to-equity ratio is below 20%, and the company is well positioned to further pay down debt, boost its already lofty dividend, and repurchase up to $10 billion in common stock in 2022. If this still isn't enough to convince you that Chevron is a safe long-term investment, consider this. Due to reduced capital investment during the pandemic and Russia's invasion of Ukraine, global oil and gas supply should remain constrained for years. Which of these Warren Buffett stocks do you believe would be the best fit for your portfolio? Please share your thoughts with us in the comments section below. Thank you for watching, and don't forget to subscribe to our channel for new investing videos weekly.